Mike Mazzei and Cyndi Munson offer Oklahoma two different economic directions. The central question is not which set of promises sounds best. It is which plan responds to what employers and families say they need, and which candidate can show how the numbers add up. This is the central economic development question in the governor's race. Will Oklahoma finally provide the skilled workers employers say they need, or will it offer another round of tax cuts and incentives and hope a workforce appears? In 2018, Boeing said there were not many experienced engineers in Oklahoma. A Tinker official said future work was limited by the number of engineers and computer scientists the operation could hire. By 2024, engineering-related degrees awarded by Oklahoma public institutions had fallen by about 24%. That is the contradiction at the center of Oklahoma's strategy. The state subsidizes companies that need engineers while the pipeline producing engineers gets smaller. A payroll rebate cannot pass calculus. A tax credit cannot graduate from engineering school. A ribbon-cutting ceremony cannot design an aircraft. The 2026 Oklahoma Business Leaders poll surveyed 401 owners and executives. 74% identified workforce and education as one of the two most important issues affecting business growth. Nearly half called recruiting and retaining workers their greatest obstacle. 89% supported improved educational outcomes. Median household income is $65,039 in Oklahoma, compared with $80,734 nationally. From 2018 through 2023, Oklahoma income grew 3.2%, half the national rate of 6.4%. Poverty was 14.9%, compared with 10.6% nationally. For years, Republican leaders have treated tax policy as an all-purpose economic tool. Need jobs? Offer an incentive. Want a company to relocate? Offer a larger one. Worried about growth? Cut the income tax. If the results do not arrive, repeat the prescription at a higher dose. Mazzei proposes reducing the individual income tax rate from 4.5% to 3% in his first year, ultimately eliminating the individual income tax and abolishing property taxes for seniors. He calls the first step revenue neutral because he intends to eliminate deductions, exemptions, and credits. The proposed $4 billion Inola smelter would be controlled 60% by Emirates Global Aluminium, based in the United Arab Emirates. Century Aluminum would own 40%. The project has been offered a $500 million federal grant and an Oklahoma package including $275 million plus major tax exemptions. Capital is fungible. A foreign majority owner does not become domestic merely because the factory sits in Oklahoma. If the project is economically compelling, why is so much public assistance required? Large investment firms finance industrial projects around the world. Why must taxpayers absorb so much of the risk? Mazzei changed from criticizing the smelter subsidy package to supporting the project after President Trump endorsed it. Munson voted against the 2025 incentive package and remains opposed because of the public subsidies and possible effects on land, air, water, and nearby communities. Nothing in Mazzei's tax plan directly answers the workforce problem businesses have placed in front of him. Lower taxes may improve one line on a company spreadsheet, but they do not create teachers, nurses, engineers, technicians, welders, or computer scientists. Oklahoma has struggled to retain fully trained teachers while employers report persistent shortages of educated and technically trained workers. This chart shows correlation, not proof that emergency certification alone caused every decline. The economic point is simpler. A state cannot weaken its teacher pipeline and expect its engineering pipeline to strengthen on its own. Oklahoma collected about $13.537 billion in state taxes during fiscal year 2025, excluding federal grants. Net individual income tax collections were about $4.926 billion. A one-third reduction equals roughly $1.642 billion, or about 12.1% of all state tax collections. This is an estimate of scale, not an official fiscal note. Taxable income, deductions, and taxpayer behavior could change the result. But the timing problem remains. The rate cut begins in Mazzei's first year, while savings from protected or committed incentives may not arrive in that same year. The shadow budget analysis estimates that major credits, incentives, tax preferences, and set-asides grew from about $180 million annually in 2005 to roughly $1.5 billion. Mazzei cites a figure closer to $2 billion. Either amount deserves an independent review, but not every commitment can be canceled immediately. 3 politically or legally difficult categories total about $525 million. The private school credit is authorized at up to $275 million. The taxpayer endowment set-aside is $200 million. Quality jobs costs about $50 to $53 million annually. Quality jobs is not merely a tax credit. It makes quarterly cash payments of up to 5% of qualifying new payroll for as long as 10 years. From 2011 through 2018, participating companies generated approximately $524.8 million in rebates. Oklahoma County received $259.8 million, or 49.5%. Tulsa County received $155 million, or 29.5%. Together, they received 79% of rebates while representing 54.9% of private employment. By 2018, Oklahoma and Tulsa counties together received 84.5% of quality jobs rebates. Oklahoma County alone received 61.2%. Legislators from the other 75 counties should ask why their constituents finance benefits increasingly concentrated in the 2 largest metros. The evaluation found that 73.7% of rebates went to industries whose employment growth lagged Oklahoma overall. In 2018, 22 participating companies paid below their county average wage. 9 were at least 20% below it. Professional sports generated $40.8 million in rebates from 2011 through 2018. In 2024, lawmakers created a new major sports rebate program. It can pay qualifying teams up to $10 million in a year after an earlier quality jobs contract expires. Forbes valued the Thunder at $300 million in 2008. Its 2025 estimate was $4.35 billion. Oklahoma City voters also approved a mostly public $900 million arena, with the ownership group contributing $50 million. The Incentive Evaluation Commission has documented that confidentiality requirements can prevent evaluators from separating payroll and employment data by individual project. Commerce may be protecting proprietary information, but it is spending public money. Trust us is not an audit standard. Senator Dave Rader proposed a county wage requirement and a shorter filing deadline. The Senate passed his Bill 32 to 15. A House substitute removed those protections and expanded eligible industries. The House passed its version 51 to 41. The Senate did not give final approval, and the bill did not become law. Eliminating a deduction, exemption, or credit increases the effective tax bill for the person or company receiving it. The state may remain revenue neutral overall, but individual taxpayers will not. Mazzei must identify who loses each benefit and why the trade is justified. Republican campaign advertising will almost certainly warn that Munson intends to raise taxes. That charge leaves out the most important fact about Oklahoma law. No governor can raise a state tax alone. Article 5, Section 33 of the Oklahoma Constitution, strengthened by State Question 640, requires a revenue-raising bill to receive approval from 3/4 of both legislative chambers or be submitted to Oklahoma voters. A tax increase is legally possible, but politically improbable. The real question is not which candidate can invent new money. It is which candidate will change Oklahoma's spending priorities. Both should publish a ledger showing what they will spend more on, what they will spend less on, which subsidies they will end, and when savings become available. Mazzei proposes an immediate income tax reduction estimated at about $1.642 billion while protecting or supporting major commitments. He must show which deductions, credits, programs, or services would be reduced quickly enough to keep his promise revenue neutral. Munson faces the same arithmetic from the other direction. Her education, health care, and workforce priorities better match what employers and families say they need, but those priorities still require money. The clearest funding source she has identified is eliminating the parental choice tax credit. Mazzei proposes eliminating property taxes for Oklahomans age 65 and older. Age alone is not a measure of need. A retired homeowner with a multimillion-dollar house and top-tier income could receive full elimination while a younger working family receives nothing. Oklahoma already has targeted senior property tax relief, but lawmakers allowed it to decay. The household income limit remained $12,000 and the maximum credit remained $200. A realistic alternative would update and index the limit, raise the benefit, and protect local schools. Munson's emphasis on public education, teacher pay, healthcare, workforce preparation, and family affordability is more responsive to what Boeing, the chambers, and Oklahoma business leaders have identified as economic constraints. That does not give Munson a free pass on arithmetic. Public investment must be financed, prioritized, and measured. She should publish the cost, timetable, and expected workforce result for each major proposal, and identify which existing credits or appropriations she would reduce. Nearly half of Oklahoma births in 2024 were covered by Medicaid or Sooner Care. That was 23,694 births, or 49.7%. Health care is not peripheral to workforce policy when employers describe a healthy workforce as an economic necessity. Munson has called for eliminating the parental choice tax credit. Complete repeal could free roughly $252 million under the current cap. But it is unlikely to pass a Republican-controlled legislature. Politics is the art of the possible. The Tax Commission reported $252.3 million in approved private school credits. Only $52.4 million was tied to verified household income of $75,000 or less. $177.6 million went to verified income categories above that amount. And Oklahoma's promise-style income limit, adjusted for household size and phased out gradually, could preserve help for families with limited means while recovering roughly $170 million. That is not Munson's current position, but it is a plausible bipartisan alternative. Mazzei should publish the list of deductions, exemptions, and credits he would eliminate. He should explain what happens if first-year savings do not reach $1.642 billion. He should provide the fiscal estimate for senior property tax elimination and explain why he would retain quality jobs and sports rebates. Munson should publish the cost and timetable for her education, health care, and workforce proposals. She should say whether she would accept an Oklahoma's promise-style income cap if full repeal cannot pass. She should identify which business incentives she would end and where the verified savings would go. Mazzei is right that the shadow budget deserves review, but wrong to assume undisclosed savings will immediately replace a tax reduction equal to roughly $1 in 8 of state tax collections. Munson's priorities better match employers' needs, but she must turn them into a funded plan capable of becoming law. The realistic middle course is targeted policy backed by arithmetic. Audit every incentive. Publish its cost and results. Honor binding commitments while ending failures. Cap private school credits by income and household size. Modernize senior property tax relief. Direct verified savings toward the workforce infrastructure employers requested. Oklahoma does not need another promise that prosperity will trickle down after one more tax cut. It needs an economic development plan that starts with the people who make growth possible. The customers have already told Oklahoma what they need. The question for Mazzei is why he is still trying to sell them something else.